Broadcom getting punished today as AI investors still wonder about what lies ahead and whether all that CapEx spending for some of the big tech is going to deliver dollars to them. My next guest notes that every CapEx cycle does eventually turn to tears. Let's get more from Marko Papic, chief strategist at BCA Research. Thanks for joining us today.
Absolutely. Thank you for having me, Marilla.
So I'm sure some are already crying watching these stocks. What's your read on where we are in the AI cycle?
You know, it would be very curious that it ended only 18 months after it started. So history is very clear on this. Every single capital investment cycle throughout history has always ended in tears. We just can't, as human beings, we just can't stop building too much of what's new. So from the canals to the telegraph to the phone to everything else, this has always happened. That said, this particular cycle started only 18 months ago. So I don't think that the end of the CapEx cycle is going to end in 26. The problem, however, is that we haven't really had any news flow on the AI front that's really profound. You know, nothing has really compelled us to download a new app over the last 12 months. And so investors are going to want something like that in the first or second quarter of 26 in order to justify all this data center buildup.
Okay. Do you feel like right now it's the process of picking winners and losers, or are we not even there yet?
I don't think we're there at all. First of all these LLMs look relatively the same. There's fear that they're going to end up being internet browsers, which, of course, as you know, because you use one every day, you don't pay for one. So there's a lot of questions that are still being asked. And I think that the data center build out is, you know, people are starting to scratch the surface on how many of these are financed. At the beginning, it seemed like the hyperscalers were just dipping into their cash hoard and investing that into data centers. That's no longer really the case. There's a lot of issuance, a lot of debt issuance. It's, in fact, potentially even crowding out some of the treasury issuance in 2026. There's private credit involved, private equity firms, all sorts of nexus of circular financing that's, you know, causing a lot of investors to ask, am I the last dollar in the data center trade? So again, I think the proof is going to be in the pudding. And what I mean by that is that there needs to be more news flow on the AI utility front. And so that's why we're watching the adoption across enterprises. We're also watching whether businesses actually start seeing productivity enhancement. And the data so far is inconclusive.
Okay, so do you think next year then will be more of the same, where investors are looking for how this is paying off, how the investment paying off, and expect to see that more clearly next year?
Over the course of 12 months, yes. But I think Q1 is going to be very tough. You have a lot of things that bothered us in 25, you know, whether it's tariffs, whether it's geopolitics, whether it's fiscal policy and bond market reaction to it. A lot of those things were answered in a very bullish way, but they were answered like 3 months ago. So all the good news is already done. So I think Q1 is going to be tough, no matter how you look at it. There's new questions now being asked, which is, why is the 10-year yield stuck at 4.1%? That's not good for equities. That's not good for consumers who could be re-leveraged if borrowing rates come down. The second question is CapEx in the data centers. Is it necessary? Do we need all these data centers? And right now, I don't think we have answers to that. So I think that the stock market probably needs to go down significantly in Q1, not because of a recession, just because we don't have answers to these questions. And then those questions are likely to start being answered Q2, Q3. So what I would tell investors right now, don't get overall too bearish on the year, but I do think Q1 is going to be tough.
Okay, you're bullish on Europe for 2026. Why is that?
Well, I'm bullish because I think that all the answers are going to be given by May. Why May? What's curiously going to happen in May? We're going to have a new Fed chair. And the new Fed chair is going to drive monetary policy of the United States of America into a definite dovish direction. Right now, everybody in the market is pretending that Kevin Hassett is somehow too dovish, that he will careen central bank independence off the rails. I think that's weird. I think that's unfair to Kevin Hassett. He worked for very centrist presidents or presidential candidates on the Republican side, so he's not unorthodox. But the market has decided that it wants a certainty on who the next Fed chair will be. I think ultimately by May, after a little bit of a sell-off into Q1, everyone will be desperate for that dove. I think that dove will come. And so my message to investors is you don't want to fight the Trump in 2026. Monetary policy will be dovish. And I think that the United States will probably have interest rates 50 basis points lower than it should. And that will be amazing for stocks. The problem, particularly for Canadian investors, is that on a currency-adjusted basis, S&P 500 may not look great. So I think that we will have another run of non-US outperformance. And so if I was domiciled in Canada with a CAD as my reference currency, I would start really thinking about how much exposure I want to the S&P 500, because S&P 500 could easily go up, 8 to 15% next year. But if the US dollar is down 10%, then you probably should have been in Europe, in Japan, in China, and in Canadian stocks as well.
Okay, let me ask you about sectors beyond tech, which is where we started the conversation. In North America, what are the other sectors you are liking for 2026?
So one of the reasons that I'm bullish on the economy, with some reservation, but I think that President Trump and Treasury Secretary Scott Bessent are going to focus on really reviving the consumer. And American household is not levered, so they can re-lever. And that's one of the reasons why I think monetary policy will be quite dovish, to suppress borrowing rates and to restart some sort of a housing cycle. So what I'm bullish on the sectoral basis, I think that housing and consumer discretionary can actually have a pretty good recovery in the second half of the year if borrowing rates do come down. I also do like commodities, energy as well. I think oil prices could have quite a nice recovery. This is one of the reasons, not the main one, but one that I would be bullish on the Canadian dollar and also just Canadian economy in general. I think there will be a recovery. I think oil prices can finally find a bottom also in the second half of the next year. And on the commodity front, I think as the rest of the world realizes that the U.S. can no longer fiscally stimulate as easily as it did in the past, I think commodities are likely to do well for two reasons. One, dollar decline is good for commodities. Mm-hmm. But second, how do you offset decline in American aggregate demand? If you're China, Europe, Canada, or Australia, you're probably going to build some ports, build some roads, repair some warehouses. And so you should see global capex continue throughout the next 12 months.
All right. I got to leave it there, Marko. I'm out of time, but appreciate your time. Marko Papic, Chief Strategist, BCA Research.